In this chapter, we will discuss what is GST and we will go into the details of the GST model and its features. After a decade-long wait, India will finally implement the Goods and Service Tax from July 1. The GST will help remove tax barriers between states, creating a single market. Goods and Services Tax is an indirect taxation in India, merging most of the existing taxes into a single system of taxation. Most countries have a single unified GST system. That means a single tax will be applicable all around the country. However, in many countries like Brazil and Canada, there is a dual GST system, where dual GST is charged by both the federal and state or provincial governments in the country. In India, a dual GST is proposed. After that, a Central Goods and Services Tax (CGST) and State Goods and Services Tax (SGST) will be charged on the tax value of every purchase or supply of goods and services. Let's talk about the features of our dual GST system. GST shall have two components, one levied by the center and the other levied by the states. Central GST and the state GST would be applicable to all transactions of goods and services made for a consideration except the exempted goods and services. Central GST and state GST are to be paid to the accounts of the center and the states individually. Since the central GST and state GST are to be treated individually, taxes paid against the central GST shall be allowed to be taken as input tax credit for the central GST and could be utilized only against the payment of central GST. Cross-utilization of ITC between the central GST and the state GST would not be permitted except in the case of interstate supply of goods and services. Ideally, the problem related to credit accumulation on account of refund of GST should be avoided by both the center and the states, except in the cases such as exports, purchase of capital goods, input tax at higher rate than output tax, etc. Some more features of GST are: to the extent feasible, uniform procedure for collection of both central GST and state GST would be prescribed in the respective legislation for central GST and state GST. The states are also of the view that composition compounding scheme for the purpose of GST should have an upper ceiling on gross annual turnover and a floor tax rate with respect to gross annual turnover. The taxpayer would need to submit periodical returns in common format as far as possible to both the central GST authority and to the concerned state GST authorities. Each taxpayer would be allotted a PAN linked taxpayer identification number with a total of 14 or 15 digits. This would bring the GST PAN linked system in line with the prevailing PAN based system for income tax, facilitating data exchange and taxpayer compliance. The indirect taxes from state and central level that are going to be integrated with GST are stated clearly in the table. The diagram in the frame clearly shows the functioning of the dual GST model within a state. For the above system to be practically applicable, cross-utilization of credit of CGST between goods and services would be allowed. Similarly, the facility of cross-utilization of credit will be available in the case of SGST. However, the cross-utilization of CGST and SCST would not be allowed except in the case of interstate supply of goods and services under the IGST model. The method to calculate the tax under IGST model is clearly specified under the IGST model working example. The formal method of calculating is described as: in case of interstate transactions, the center would levy and collect the Integrated Goods and Services Tax (IGST) on all interstate supplies of goods and services under Article 269A Section 1 of the Constitution. The IGST would roughly be equal to CGST plus SGST. The IGST mechanism has been designed to ensure seamless flow of input tax credit from one state to another. The interstate seller would pay IGST on the sale of his goods to the central government after adjusting credit of IGST, CGST and SGST on his purchases in that order. The exporting state will transfer to the center the credit of SGST used in payment of IGST. The importing dealer will claim credit of IGST while discharging his output tax liability, both CGST and SGST, in his own state. The center will transfer to the importing state the credit of IGST used in payment of SGST. Since GST is a destination-based tax, all SGST on the final product will ordinarily accrue to the consuming state. The taxable event under the existing structure depends on the levy and the defined independently without any harmonious reference to other indirect tax legislations. GST is envisaged to be levied on supplies of goods and services on same taxable event by both center and state governments. The term supply is expected to be defined in the CGST, SGST and IGST laws being prepared in this regard. It is critical that the term supply is defined in the central and state GST legislations in an identical manner to avoid the challenge of multiple taxable events at central and state level in GST. Under prevailing indirect tax structure, there are multiple taxable events on account of multiple levies at the central and state level. That is, taxable event occurs on manufacturing of goods in case of central excise laws, sales of goods in case of state VAT laws. In addition, taxable event in case of other state levies such as entry tax, octroi, etc. are on entry to goods into a particular jurisdiction. The Kelkar Committee 21 recommended multiple tax structure restricting the structure to 3 ad valorem rates in addition to the zero rate, which are listed in the frame.